Hey everyone, it's Matt again. And I just wanted to give an update. I think I'll probably do a market update every so often. Just give you my thoughts on what's going on. Today's tape action is pretty insane. We got lots of volatility in the market. So basically, for those of you who are newer to like futures and trading and all that stuff, volatility, the VIX, pretty much measures the S&P 500 and it tracks its volatilities. So if volatility is around 30, that typically means that the S&P 500 is going to go 1% in either direction. So it could be a 1% down, it could be a 1% up, but that's not guaranteed. And the direction is also not guaranteed. So volatility pretty much does that, but it's not a velocity index, meaning it doesn't measure like X over time. It's X over the rate of change. So it's a second level derivative. It's like an acceleration. So as VIX goes up, that 1% that the S&P moves will go up much faster, exponentially. But that doesn't mean that the market's gonna crash if VIX is high. It just means that there is a higher likeliness that it will. And basically the way it's kind of calculated is the options market. So if people are buying a lot of options, then that drives the VIX to be a little bit higher. Each individual security has its own kind of VIX calculation. You can't really find that on most platforms, but it's the implied volatility, anyway. Today's market pretty good. We were up this morning, then went back down. Really good for my positionings. I was wrong on my directional assumption on Teladoc by quite a bit, so I was able to leg out of my trade for a small 37 cent or $37 in actual dollars, 37 cents in the market, in the options market. Kind of a loss, which is actually really good considering my directional bias was a expected move down, and it actually went up. It went up about $3, still inside the expected move, but it was definitely not what I had assumed it was going to do. I was thinking Doma and a lot of these other pandemic stocks, they had their earnings. The earnings are great. Guidance was okay. Guidance was actually really good for Doma. The reason they went down, hypothetically based on logic, which you should never use when you trade, but based on the logic of the narrative, is that their market share went down. So even though they are gaining traction, earnings are going up, their accounts, maybe they had 100 accounts and now they have 80 accounts. That's even though they're growing in revenue, growing in pricing, their overall market has their market has grown, but their control of the market has shrunk. So that could be different for Teladoc, and maybe they have an expanding market. I don't know, but they're still only probably $63 to $66. 68 was their high today, and during the height of the pandemic, they were well over $300, I think. So definitely trading on their lows, trading on their butts. 80% down is pretty bad. Who knows if they could go lower? I'm out of the position, but that's my position update. I didn't play any other earnings last night. I do have core positions on. I'm short the SPY. I am a little bit now long the NASDAQ because my position, just when I put on my neutral position about 2 weeks ago, were actually lower than where we were 2 weeks ago. But still profitable on the trade. I might take it off today. Depends on how the market does. If the market has a tick up in volatility, I may sell an iron condor out in April expiration. We're about 50 days right now, so just about the place I would start selling my longer positions for my iron condors. My directional plays, I'm still short, pretty short. Roku, pretty short. MU. I'm pretty short. What else am I short? I'm short Tesla, which is working out. I don't take that big shots, to be honest. Usually what I would do is I sell a call spread and I'll sell a broken wing butterfly on the bottom, just to give myself a little bit more room to be wrong. But because I have a directional bias, I want to kind of get a little bit of a kicker. But historically speaking, I'm usually not lucky. So I have this book. But anyway, so what I do then is my directional bias, I'll sell more premium in the opposite side. For example, I'm bearish in Tesla. I sell a call spread, out of the money obviously. And then I buy a broken wing butterfly, which kind of makes it like a synthetic wider iron condor, but with the kicker that if I do get my directional bias, as long as I'm not, as long as it doesn't get destroyed. I mean, my long put spread is like a 575, 570. So that's, granted, Tesla did fall like $80 in the last 2 days. My call spread would be, hopefully, I'd take it off at 50% profit, and then my broken wing butterfly, be able to buy it back or sell it for a little bit of a credit. But my main goal is to take out about $100 out of this trade, which is a little bit more than you would off of off of a $500 wide iron condor. $500 wide iron condor probably take out about $75 to $80, depending on the volatility there. Of course, I could lose a lot more, but that's the benefit you get when you trade short premium with kind of a larger room for error, so to speak, where you risk 3 to make 1, but your probabilities of winning is 68%. So it does kind of play to your favor a little bit. None of this is guaranteed. I trade like this because it kind of gives me a mathematical edge as far as how I think about things. But market action has told me and taught me that for an investment portfolio, really you just buy and hold. I have a separate retirement account that I don't touch. It's just a whole bunch of index funds, probably actually only like 3 index funds, to be honest. A little bit of gold, a little bit of bonds, something very simple. Tactically speaking, I have no idea really if it is tactically sound to do. Strategy wise though, like long-term strategy, it's the only thing that has worked really. Nowadays though, because we're so concentrated in like the top 5 stocks of both the NASDAQ and the S&P, that sometimes I wonder if just holding the stock and selling covered calls on it would be a better deal for me. But I don't know, and I don't really want to think about that. My main objective, as always, is just to be invested, time in the market, and then my trading is what it is, right? I trade options, and I'm a short premium seller or short premium trader, so I trade short premium. So if I have a bias, I can potentially be, statistically speaking, more right, or actually it's less wrong. So with a premium, with the strategy that I have a defined win for defined risk. So instead of buying like 100 shares of, let's say, the S&P 500 and putting up $42,000 of capital, I can put up, let's say, $500 of capital, and my goal is to make $250 of capital, and I really don't need that big of a move. I might just need a 5% move in the SPY, and I would get my 50% return. Now granted, with a small move downwards, maybe if the S&P went 5% down, I would be out of my position. I'd be completely, I'd lose my $250. But if I had the S&P 500 shares and they lost 5%, I would have lost $8,000. So it gives you a little bit more of a way to express your directional bias without really getting killed. It can be deceiving though, because with little chunks like that, if I just were to buy the SPY, I'd have to commit $42,000 to the trade, whereas if I did it with the options, I would literally just have to commit $500 and I could be wiped out, right there, right? Completely wiped out. And that's why the trade small, trade often kind of rule comes into play. Now, yes, you do get eaten up on commission and fees a little bit, but the trade, the amount you pay for that commission is so small anyway, that if you truly want to generate yourself some alpha, you believe you can beat the market, this is the only way to do it. If you believe you can beat the market by stock picking, then that's an investor mentality, and that's a little bit different, as even the professional fund managers whose job it is to beat the market, not many of them have. Warren Buffett even said, just go ahead and buy the SPY or some index fund and you'll be good. He even probably not explicitly, but kind of like in passing, that you might as well buy the SPY versus even his own fund, because his own fund does have difficulty beating the market. And in all honesty, Warren Buffett's fund looks pretty much like a NASDAQ SPY right now because he holds so much Apple. But that's a good deal. Apple's amazing. 100% honesty here, Apple is probably the best performing stock we have in the market. It holds up NASDAQ. It probably props up SPY. It's a pretty damn good thing. But yeah, that's kind of all. I don't know where I'm going with this video, but I just wanted to give everyone kind of a brief update what's going on, what I think, how I make my trading decisions. If you want more like this, if you're here to the end of this video, you probably want to know more about how I trade. Let me know in the comments, and I will do what I can. I do have a Series 66 and Series 7, so there's a lot I can't do online. It's unfortunate, personally, everything I do is not a professional recommendation. If it was, all fund managers would be out of a job because they manage money worse than indices. But anyway, I digress. I will see you all in the next video.